Hello and welcome back to the Sovrenfx YouTube channel. So today's video will be on using stop loss orders and how to place your stop loss orders. As we all know, forex trading can be a profitable venture, but it also comes with its fair share of risks. That's why it's essential to have a risk management strategy in place to protect your investments. One such strategy is the use of stop loss orders, compiling it to the ATR, which can help limit your losses and maximize your gains. In this video, we'll go over what stop loss orders are, how they work, how I personally place them, and why they are crucial for forex traders. So whether you're a beginner or an experienced trader, stay tuned for some very valuable insights into using stop loss orders in forex. So personally, I use the ATR. The ATR is one of my favorite indicators. I don't trade with indicators, but I add it to the arsenal that I use to fight the markets. So without further ado, let me show you how I set it up. So go to the indicators tab on your trading view terminal, search for ATR. Just take the first one, average true range. This is where it will appear. So I want to teach you how I use this ATR to help me determine my stop loss and also my take profit. Okay, so first things first, let me try and cherry pick a trade that I would have taken and would have almost gotten stopped out, but using the ATR I wasn't. So let's use this as an example. So as you can see, this is the trade. This is a fake out trade, and these are my zones. If you watched the previous videos, you understand how I plot my zones and key levels. Okay, so price closed above, so we're waiting for it to form a support above this area for it to go up, but it failed and closed back into the range. As we all know, not we all know, for the people who have been to the channel and also new members, this is what we call a fake out. So here's how I would have taken the short trade, as it broke the low of the previous candle. Okay, so how do you place your stop loss? In this scenario, this candle moved a total of 67 pips, and one thing I've realized, you don't want to enter the move when price is already down more than 20 pips. You always have to wait for your entry. Okay, so your entry should be closest to your zones, and once price goes far away from your zone, wait for it to react to the next zone. If it doesn't and it pulls back and still can't break this resistance or zone, then you can take your trade. So simple. Here is how I enter the trade. I have my stop loss above here. So here's our entry. This is where we took the trade, but here was our setup, our fake out setup. This is what we were waiting for, but we couldn't take the entry here, so we had to wait for another price formation and price action to actually guide us on the next place we could take this trade. So price failed to break above the resistance and formed a strong resistance below. So once it closed bearish on the 30-minute, let me zoom in, I execute the trade here. And how do I come about this stop loss? As you can see, when I bring this line over here, the ATR, you have to check this value. So if I bring it here, the value is 36. Okay, so 36, let me write it down somewhere. My stop loss is always 1.5 times the ATR. Stop loss is 1.5 times the ATR. Okay, so 1.5 times, here's the line, we have 36, so 1.5 times 36, it should be around 52, 54. I think it's 54. Let's use 54 for the time being. So this is where our stop loss would be, 54. And coincidentally, it's above the previous candle low here, making sure that if price comes back and breaks this, it nullifies this trade. And it's all a game of probabilities. You don't have to be 100% right, but you want your stop losses to be at a reasonable area where price can't pull back, stop you out during liquidity grabs. Okay, so here's our stop loss at 54 pips, 1.5 times the ATR, this value on the side of the ATR. And your first take profit, you can have it at a 1-to-1, but rule of thumb, your first take profit, just have it at 1 times the ATR. So the ATR was 36, have your first take profit at 36. I know it looks like a negative risk to reward ratio, but once price hits your first take profit, you move your stop loss to break even and ride the whole move towards the next area of interest. So as you can see, price came, tapped the area of interest, and if you realize, it formed rejection wicks. So this is the difference between a normal candle and candle with rejection wick. When the wick body, the wick is this part without the body of the candle. So when the wick is bigger than the body, that's a rejection wick in the area of interest. So when candles come to this area of interest and you see the wicks are bigger than the bodies, this is a very strong area of interest, the support, and price couldn't break it at that time. So what do? You close your trade here and watch out for the next trade. So that's basically it. Having your stop loss at 1.5 ATR and your first TP, let me have it as take profit 1 times the ATR. So this is the way I place my stop loss and take profit. Risk management, I made a video on risk management, how you can use static and dynamic risk, whereby if we could have entered this trade here, we would have entered one trade, and the second trade when price pulls back. So I'll link the video above so you can watch how you can manage your risk, but this video was only about setting your stop loss orders and take profits. So this is the free tool. If you use the ATR is simply the average of the previous candles, and in our situation, the input for our ATR, okay, here's our ATR, 14 length. So we are looking at the input of the previous 14 candles, how much price has moved during that period. So if price has moved 36, you want to have your stop loss just above the movement of the market, in that it can't pull back more than it has already moved. I think you understand, or I've tried my best to make you understand why I use the ATR. Your stop losses might be big, and if you realize you can't handle the stop loss, just drop down to the 15-minute time frame, whereby the ATR will be smaller. So if we took this trade on the 15-minute time frame, our ATR would be at 31. So at 31 times 1.5, we would have something along the lines of 46 pips as our stop loss. Okay, so yeah, that's basically it. Some people use the ATR for entries. I'm not sure how they use the ATR for entries, but it's one of my favorite indicators, since it tells you how much price has moved and where you should place your stop loss so that you can get cushioned by the move. And if your direction is correct, any pullback won't tap your stop loss. And if it does, it's one in the 80% probability that's 1 out of 10 trades that will hit your stop loss, if and only if you have the direction right. Okay, so with that, in conclusion, stop loss orders are essential for risk management and for forex traders. They help limit potential losses and protect your investments from unexpected market fluctuations. By using a stop loss order, you can ensure that you're not risking more than you're willing to lose, and you can have more control over your trades. Remember, successful trading is not just about making profit, but also managing risk effectively. So don't hesitate to incorporate your stop loss orders into your trading strategy and stay disciplined in your approach. Thank you for watching, and I hope you found this video helpful. See you next time.